So, you're thinking about buying a home, but you're watching home prices climb rapidly. You see homes listing for sale one day and then showing offer pending the very next. You see buyers outbidding one another, and you ask yourself, wow, is this a boom or a bubble? Should I hold off or should I get on it? Stay tuned as the RLS boys discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We're excited for another episode. We've got a great topic. Erik, you are in via satellite from Seattle, right? I guess not via satellite.
But from a remote secret location.
Yes.
In the specifically a basement bunker between babysitting my 3 and 5 year old granddaughters.
How's that going so far?
That's fantastic. That is fantastic. You know, language development, Roshan, you see this in your own children, and so you have much more fresh recollection of all of this process. But it is amazing. Between every, let's say, 6 months when we see them, you get to kind of do a little sampling of their language development. It's unreal how quickly their language develops at this age. I just am blown away by it.
Are there any new phrases that caught you by surprise, or is this just in general?
Well, it's the ability of my 3.5-year-old. Remember, she says 3.5, not 3. You got to know there's a big difference, she says, between those two things. Just the things words I wouldn't be expecting her to say, or sort of, for example, this morning I think it was similar. Yesterday it was container, and I'm thinking, did 3.5-year-olds know those kinds of words? I didn't know that. My 5.5-year-old, let's emphasize that, is truly reading these storybooks, and I'm thinking, I don't remember reading storybooks at 5.5. I don't. Anyway, so it's just incredible to me. So I'm delighted by it.
That's awesome,
great.
Erik. And you speak a lot of different languages, I heard too, Erik. Maybe you could help them out with that too. That'd be awesome.
So yeah, a little bit of Chinese, we could throw that in there for just the interest factor.
Yeah, they actually teach that now in my kids' schools in Fairfax County.
Do they?
So they know the colors, they know how to count. They teach them Chinese at their school. I don't know if I imagine it's not at all schools. I don't know why theirs versus others, but they have a lot of good language-driven program. We're lucky to have that in our county.
Oh, fantastic!
So yeah, keep that language development going. Not only in English. That's great though. Glad to hear you're having fun out there. You're there all week, right?
Actually, 2 weeks. So mom and dad left yesterday for their to attend a wedding outside the country, and so we're on duty now for the coming 7 days, and then we get to sort of decompress for a while with mom and dad back.
Okay.
So it'll be great.
I'm sure you'll be excited to have what I'll say for you to have the help, because when they're back, as opposed to you helping them. That is wonderful.
Right.
Enjoy it out there. We'll be recording live again next week from there with you, which will be fun.
You'll have a report.
Yes. But we've got a really good topic today. Today we're going to talk about housing, where things stand. I know we're experiencing that in D.C. There are national numbers about it as well, as far as just how crazy the housing market's been over the last really year, for the year of 2021. And we want to share some insight, give some thoughts with what's going on out there. And I think this is a very important topic because a home purchase or sale is typically one of the biggest transactions that anyone goes through, right? In terms of just sheer dollar amount as well as sheer paperwork you end up signing and initialing when you go through that process. So people will often ask, is this a good time or a bad time? It's gone up so much. What's going to happen? So we're going to try to break that down for all of our listeners today. I want to start out with something, Adrian, that you had pulled about buying conditions from its University of Michigan survey on buying conditions that, Adrian, you were great to have found that, just because I think it's a great start for us. It actually said that we are in the worst buying conditions that we've had since the 80s, which is very interesting to me because when you think about how high interest rates were back then, home prices have definitely, interest rates are low now, but home prices are up. But I thought that was a good start for us. Now, University of Michigan does this by surveying people. But gentlemen, what are your thoughts on that buying condition, just that statement? I tried to get us the survey questions and so on because I wanted to dig deeper as to where they got it from. But if I just say that statement, worst home buying conditions since the 80s.
Yeah, it's definitely really interesting. Something just to make note of. Like people have been seeing just home prices have just been continuing to go up. And then there's the other aspect of it, of the supply and demand side of the housing market right now, where just supply is so low and demand is so high that it's just kind of fueling this housing price. And then we also have like the interest rate environment, which we'll get into. But it's just really interesting just continuing just to watch this. And then there's the conversation and like the article that we were prepping with is this like a bubble? Are these home prices like set to fail? Like what is this condition? And then what's going to happen? I think is something that people are really trying to follow and just to see, because these home prices like are just going up so much, and the supply and demand aspect of it isn't helping it at all.
So, when your initial reaction to that worst buying conditions in decades, were you surprised to see that, or was that pretty much in line with your thinking?
I mean, it is in line, like again, with how supply and demand is. It does make sense, but it's just when you look at the charts and when you look at the data, it can just be very, just like a lot to take in.
And Erik, how about you? When I give you that statement, worst home buying conditions in decades, are you surprised to hear that, or is that in line with your thinking?
Oh, I would say it's in line with my thinking. If you go onto whatever resources you tend to consult when you're looking, just exploring, hey, what homes are available, where, at what prices, and how long are they staying on the market, you look at it and you say, wow, those things are flying off the shelves. The average time now, or the median time on the market, is about 1 week, and sellers are on the median transaction is occurring at the price that the seller was asking for. That means some portion, of course, were above. I know when I bought, it was above. And the same time when I bought, this was back in November of 2020. When we offered a price, our real estate agent, the broker, had said, hey, list at this price. We said, we don't think so. We think it makes sense to list $10,000 more. She says, I don't know. So we throw it out there, $10,000 more. We get offers $20,000 more than what we listed. So it's, it's crazy. And it's been crazy as to just how much activity there is when people find a home to buy that they like. It's like, move now, or you're not going to have an opportunity. I think that's why people are so discouraged, is they can't find much, and when they do, it's gone in no time, and they have to pay. They have to pay up for it if they had been previously accustomed to buying things at a bargain.
So I'll tell you, I see all of that, and anecdotally, in the DC metro area through my clients, and my sister's a realtor who's been on the podcast before as well. I am hearing that things are still good, but they're not as crazy as they were when you sold, as far as going huge over. But that, once again, that just may be anecdotal. But what surprised me on that statement, though, is when I think of home buying, I think of interest rates first, right? Obviously, the price you're paying in total cost is very important, but most people, I think, are making their house buying purchase based on the monthly payment versus the total cost of the property, and the low interest rate making making a higher total purchase price more affordable for people. I was surprised because even with these stories I'm hearing with these historically low interest rates, I didn't think it'd be the worst buying conditions. I know competition's high, people are bidding over, but I guess I was maybe I was looking too much at interest rates, or maybe I need to spend hours digging deeper to find out what are the actual questions they asked to see how they came up with that information. But I was a little bit surprised about with such a good interest rate environment that we would be in a buying place in a place where, once again, the quote is worst home buying conditions in decades. I'm surprised that with such low interest rates, we're compared to teen interest rates, right? You're at an interest rate environment now where you can get a 3% mortgage. In the 80s, you were getting 15% plus mortgages, and they're saying now is as bad as then. That's what was so surprising to me.
Yeah, well, it's interesting. You talked about that University of Michigan consumer sentiment survey about the buying conditions for houses. They break that down into several parts. So one is the price of homes, another is the interest rate reasons. There's other buying rationales and so forth and so on. So general economic conditions. So most of the things are lined up right now, and certainly interest rates are lined up to help. But the prices, and especially the acceleration of prices, is just I'll use the expression off the charts. In fact, speaking of charts, we have some charts.
Can I take you to one other place before, just to wrap up the interest rate conversation that I started with us?
Yeah, sure.
You had a great comparison in prices with interest rates going up. Can you share that with us, and then we'll move on to the charts?
Oh, certainly. So, folks, how much does a move of 1% in interest rates affect the thinking, or at least the affordability of a home? So let's use the current 3% interest rate. Or no, actually, let's go back. Let's say that a 30-year fixed rate was at 4%, and let's say you had a budget, not including property taxes, but you had a budget for the principal and interest portion for your home that you could swing $1,700 a month. I know some of you in the DMV area are laughing just hilariously right now. You're trying to hold back your laughter, thinking $1,700 a month. What are you talking about? What kind of shack is that? But well, anyway, so
you can get some nice condos and some nice areas out here for that. So
okay, maybe I'm being a little bit too hard. It's not Frisco, it's not DC. Yeah. Okay, there we go. So or San Diego for that matter. But for $1,700 a month budget, and you have $100,000 to put down at a 4% interest rate, how much home can you buy? About a you can buy about a $450,000 home. $100,000 down, $350,000 borrowed at the 4% gives you essentially that $1,700 a month. What if interest rates drop from 4 to 3? Now you can afford a $500,000 home. $100,000 down, that same $1,700 a month can cover on that 30-year fixed $400,000 borrowed. In other words, that moved the what you were able to purchase up 10% for no additional money. Of course, I'm ignoring the property taxes in this equation. But when you think about that pressure on home prices as well, this very, very constrained interest rate environment based for the most part on the Federal Reserve's monetary policy, what that has done is it's fueled, in part, it has fueled the rise in these prices. Now, I just said that could explain about a 10% rise in those home prices. It's a little bit more than that. How much have prices actually risen? Well, over the last year, they've risen about 15%. So there's more going on here than just interest rates, and interest rates have been in that neighborhood for a while, but it certainly doesn't make it easier for people who are thinking about the price of a home and are letting the price sort of drive their thinking as opposed to that monthly mortgage payment to drive their thinking. It doesn't help to have rates that low.
Well, let's talk about that as we get into the breakdown of really our intended topic for today is this a bubble, right? Are we in a housing bubble? Which for everyone listening, why this is important for you is if you're planning to sell and rent, do you want to take advantage of this bubble and sell your place? On the flip side, if you're planning to buy, should you wait until what is potentially the bubble, quote unquote, bursts? So, Erik, great point there. A 1% drop in interest rates can cause a 10% increase in housing price purchase, but it's gone up more than 15%. Supply and demand. Just thinking back a year, people were scared to let people in their home. People weren't selling because they didn't want someone with COVID walking in their house and spreading their germs in their house, right? So the question is that additional 5% increase explainable because, or can that be explained by less people willing to sell, causing a shortage in demand?
That was my thought about a year and a half ago, and I think that might have been an initial reaction. I think there's more going on than that. How about you?
I think that's part of the equation, and there's more going on. I would completely agree with that statement. But let me actually ask both of you as we go into this. We started this conversation because there was an article we had read by a finance professor at Wharton, Benjamin Keyes, and they were interviewing him to ask him, is this a bubble or not? And his conclusion was, this isn't a bubble. Do you first agree or disagree with that statement? We are not in a bubble, housing-wise.
Adrian, how about you?
Well, if you kind of compare it to kind of the 2008 kind of housing bubble and crash, I would say that housing prices right now and just what it takes to get a mortgage and then the supply and demand side of it, most of those indications now show that it really isn't a bubble. But again, just with these increased home prices, and again, what we talked about, given the interest rate environment, if there's a change in monetary or fiscal policy, that could have some slight impact on home prices. But as far as a bubble, I kind of tend to agree with him, saying that there really isn't much of a bubble compared to just with all the changes in the housing market and the supply and demand aspect of it. I think you could say that it's not really a bubble given those points of it. What do you think, Erik?
Well, so part of this is going to be sort of borrowing some of the points that Benjamin Keyes made. By the way, he's not only a professor of finance; he's a professor of real estate and finance at the Wharton School at University of Pennsylvania. So he's on this. He's a student of what's going on in the real estate environment. But I thought he set this up pretty well. Think about the last time that housing crashed. So that was 2000, started probably in 2006 or 7, was peak pricing, and then it started to deteriorate from there, depending on the market, right? And then it bottomed maybe, depending on, again, your market, 2010, 2011-ish, somewhere in there. What was happening in there? Frenzied buying. Well, that's true now. What was happening then? Inflated prices, or at least upward pressure on prices. That's also happening now. So do those two things alone then indicate that we are in a similar environment? His argument would be, no, let's take it and let's just kind of click off some of the changes. So number one, we're going to just let this be open forum for the RLS boys to just chime in. So he makes this contract about loan standards. That was a big point. Talk about what his contrast was on the loan standard side.
Well, that's where I was going to jump in to start with what you were just saying as to why I think yes, those 2 points you made about housing prices going up are accurate, but the environment to me is completely different. So the loan standard point he makes is that they had, and this is, I always refer to this when we talk about that era and the loans. My favorite ever is the Ninja loan. Ninja stood for no income, no jobs, no assets. That means you walk into a bank and just tell them what you want to tell them, and they say, okay, we'll take your word for it. Here's a house.
A no documentation loan.
No, nothing. So, and going back, once again, this is just anecdotal information from the DMV, the DC metro area, but I knew people who would go out and buy a house. They would then pull the equity out of that house to buy another house, and they would continue doing this multiple times a year. I had met people that in a 2-3 year period accumulated 20 properties. right? And with no equity in any of them, because they would just pull the equity out to get another property. I don't know anyone in that position now, and you can't really get a loan without being able to service that debt, right? That person that was able to get the 20 properties was just saying, "Oh, I'll rent it or I'll sell it. I'll figure it out later." And the bank said, "Okay, we believe you'll figure it out later," and that was it. Right. So to me, that makes a huge difference. Just in what I'm seeing, I have clients, a few that have bought second homes for their use that they can afford. I don't have clients that are making speculative plays on real estate where they're buying properties just because they think it's going to go up next month and they can sell it. And to me, that's a huge difference.
Yeah, and you talk about some of the other just egregious practices then. Do you remember, you mentioned the ninja loan. Do you remember the negative amortization or reverse amortization loan?
Yes, talk about that.
So you would get, let's say, a note that would be an interest-only negative amortization loan, meaning, folks, when you pay off your mortgage, most of the time, right, you're making both a principal and an interest payment. And so you're gradually whittling down the principal that you owe on that debt. Well, this loan was structured oppositely. So you wouldn't even pay all the interest. Some portion of the interest would be capitalized in the loan, and your loan balance would be growing. But the premise of this type of loan was that your home price would accelerate faster than the balance of your principal on this loan would accelerate due to the negative amortization, and as a result, you would still be building equity. So I watched a guy go in and buy $1 million home with nothing down for $1,200 a month under one of these negative amortization loans. I just thought, this is insane.
Let me just put some numbers on that. If he bought this $1 million home for nothing down, and let's just say it was at 4% interest, that means his interest a year is $40,000. You said he was paying $1,200 a month, which means he's paying $14,400 on that per year. So at the end of the first year, his mortgage balance, it started at $1 million, is now $1,025,600. Right. And that it's going to go up at a greater rate than that, because after year one, you're paying interest on the original $1 million and you're paying interest on that $25,600. So that loan will just continue to get bigger, which those kind of ridiculous schemes, and they had so many of them. Teaser rates where you get in and you pay less for the first few years and pay more later, or there were multiple loans where you'd get your statement and they'd say you can pay one of these 4 payments and you pick. And the first one, it was usually like that negative amortization where it'd be less than interest, and the highest one was like maybe pay off the loan in 15 years versus 30, and people were typically paying the lowest one. So I don't see that anymore. So that to me is the first data point I would look at as to do I think this is a bubble. Now, I at the same time, my thought is that it's not a bubble. I also don't think what we've seen in recent history is sustainable. What I mean by that is, Eric, your situation of getting, telling the realtor we want to ask more than this, and then getting even more than that. The way I've looked at it, my thoughts are how I've compared it for clients as well, is I think you've sort of been advanced a couple years of growth. So I think that if you're buying at that inflated price, I don't expect your house to crash or go down significantly. Probably won't see growth for a couple years, though.
Well, here's where I'm not so sure. So this, now maybe we can get into, and first of all, I fully concede, Roshan, you're probably a lot closer, particularly just because this is, I think, an area of interest for you, and also because your sister's in the biz. You have, I think, a little bit more insight into this than I. But I would say I'm not sure. I don't think we're going to see the same rate of acceleration, but I don't know that we're necessarily going to see a flattening. And there's a few things that are underlying dynamics beyond, Adrian, you were mentioning the supply and demand factor, and so we've talked here about the underwriting of loans and that sort of thing, which is a huge element. But let's just also talk about some of the preconditions on the construction side leading into the housing peak the peak prices of 2006 and 7. You'd had a surge in construction. On the flip side, in the aftermath of the housing price collapse following that peak in 2006 and 7, you have had a lot of people very wary about whether or not the other shoe is going to drop. And so there hasn't been this ridiculous construction spree. And so, in fact, in some ways, I think you could argue, and I've heard various numbers bandied about, but we might be, given the natural supply that stems in part from boomers who've built up a lot of wealth and are ready to go, maybe not downsize, but maybe resize, maybe relocate, get closer to family, get closer to friends. They're not thinking about proximity to work any longer. They're not thinking about, they've got wealth built up through the wealth effect of all of this market rise here recently. That there's that, and then there's millennials who are coming into the market now in sort of the late 20s and early 30s, sort of peak buying years. There's a lot of pressure to purchase homes, and in the aftermath of this construction, very constrained supply. So at this stage, we might have 4 million homes as a deficit in this country right now.
So you expect the appreciation to continue versus flatlining for a little bit, just not to continue appreciation at this rate. Is that
maybe not at this rate, but I think it's. I mean, put yourself in the position of some of these millennials. If let's say you're a millennial and you happen to be among your in your cohort one of the people with the stronger incomes, you're able to buy in this market. But what has really been a tough spot for a lot of new, first-time buyers is there hasn't been a lot of construction of new starter homes. And builders are having a really hard time with this from what I'm reading. And so, in fact, I think Benjamin Key's article talked about this. Do you recall what he said about some of the regulatory environment for home builders and what they're having, how they're responding to that regulatory framework?
It seems like it's a lot more stricter now than what it used to be, which is definitely a hurdle for construction.
Yeah, and Eric, so I want to clarify my point. I don't expect a long-term flat line. I think we might see a couple years of slower, below average growth because I think it's been paid for. So I just want to make that clear. I want to go a little bit deeper on a really important point you hit on, was just this housing starts number. So we have been below average. So by average, I mean historical average, going back to the 70s. We've been below average since about 2007, right? Mm-hmm. So we have been below average now for about 14 years. We briefly got roughly to average in January 20, right before the pandemic hit. And then we were way below, at the beginning of the pandemic, and we've gotten to average. So what you had said a moment ago that I'm just trying to highlight is that we've got this extended period of short of supply, or not enough houses being built. So we've got a lot of supply that we need to catch up on. So I think that that's where the argument that you have of it continuing to go up, I think that would line up with your argument, and I do think in the long run it will go up. However, I think, one, we're not going to see this crazy growth we've had, and two, we might see a couple years of slower appreciation of housing prices. Either way, though, I don't see this as a bubble that's being burst.
And I think one thing that might be interesting, or kind of just make note of, just like going forward, is just I think there could be a possibility of just maybe not like a burst in the bubble, but maybe you could probably see it in maybe pockets or different areas. I know one thing that's big with housing is location. another aspect of it, like Eric, like you mentioned, like these millennials that are seeking for these like starter homes or buying these like homes because they're now like in this accumulation phase where they have a lot more cash on hand, are probably looking into areas where there's like job opportunities. I know that's going to be a big aspect of it that could affect like housing prices, but there's also that other thing people are watching, just this work from home trend as well, where that really might not have an impact as well, where you can work wherever you want. So I think that would be interesting compared to where 2008, you kind of saw it everywhere, where housing prices kind of went down, where now it could maybe affect maybe different areas and it's not just one like broad trend. So I think that's something to kind of take a look at and kind of just see going forward.
Yeah, well, actually, I do want to get into some of the regional differences in home price appreciation. But before we do, I want to not leave the subject of some of the regulatory constraints and then price constraints on homes. And by the way, folks, we're mentioning this not just because it's idle conversation, but it's back to this question of boom versus bubble. If some of these factors, regulatory factors, were not in place, I suppose it's conceivable that it would be, we maybe would shift our thinking a little bit more in the direction of bubble. But some of these regulatory things are very, very slow to change. And so let's talk about what some of these are, and then let's also just talk about the pricing thing. So you have a variety of barriers to new construction, particularly on the lower or the starter end of the market. So one of these is, of course, just the high cost of labor and materials. I wouldn't say that's as much a regulatory thing as just a function of a lot of people got out of the construction business, and a lot of people didn't go into the trades. And you have, I would say, I think the number I've seen is somewhere around 700,000 more construction workers right now would be needed to fill the building demand if prices of materials were okay. So getting your hands on affordable builders or construction workers is itself a challenge. But layer on top of that zoning restrictions that say where you can build and where you cannot. Another is minimum lot sizes. So you make it hard for somebody is to have higher density. A home is going to be more affordable, all else being equal, if you have permit the lot size to be smaller and the densities to be greater. And a lot of municipalities just don't want that. They associate, whatever sorts of adverse byproducts of that. But slow approvals and so forth. So when you put all the price issues and the regulatory issues in place, it just makes it hard at the starter side of the market. And so the builders, what do? Well, the place where they can make a profit is on the high-end homes. And so as a result, that's where you're seeing more of the construction actually happening, is on the high end, precisely the place that millennials are saying, what? We need something we can afford.
Yeah, and the other thing that was in there too that is impacting the millennials as well is the fact that you're getting investors that will then buy properties in these neighborhoods to rent to the millennials. You're a millennial, you can't afford to buy a house in this neighborhood. The investors will buy it and then rent it to you. What the investors are then doing is creating more demand, which is helping push those prices up, keeping the millennials out. So I think the investors are responding to the demand as opposed to causing the increase in pricing, but them buying is also supporting or increasing that market as well.
That's really true. The single-family rental market. So we won't name names, but as we've said before, one of the things that is distinctive about our firm, this isn't a sales pitch, just reporting to you kind of what we're familiar with, is that we do a lot in the area of private equity and private debt investments. And I know there's one region, I'm not going to mention the metropolitan statistical area, but where one of our sponsors is very actively building homes, not sponsors of our show. I'm saying one of the people that brings ideas to us for private equity and private debt opportunities is coming and saying, hey, this is our game plan. We're going to build a gazillion single-family rental homes in this particular municipality because the rental demand is so high because affordability for some of these people is so challenging.
Yeah. Yeah. And they are taking advantage of an opportunity that, going back to where we started the conversation, low interest rates also help them out, right? For those, you've got a renter that can't afford to get in because they don't have the down payment. You can go in, get the down payment, get the interest rate, bring in this renter. They pay down your mortgage. It makes sense. It makes a lot of sense for the investor to do.
Yeah. Well, I just in terms of the, I guess we could talk about some of the pricing and actually illustrate some of the pricing for people, but I think probably just makes a little bit more sense to just point people to some of the resources that where you can find some of these charts and graphs. So if you go to the Federal Bureau of Economic Research, so it's FRED, you're able to find there are some really pretty incredible graphs that show how prices have worked. And just to reinforce what we're saying here, things have been, after they turned down, let's say from 2006 and 7 down to the bottoming process in roughly 2011 and started to curl back up again. Once COVID hits, they stay flat for just a sec and then whoosh, they're charging higher. And I think that's what's really interesting to me is just how long does that continue. The second quarter of 2021 alone, after seeing several quarters, back in the 2019 period, you'd see home price advances that might be in the 0.5% to 1.5% area. And that would be true quarter after quarter after quarter. Then you get COVID hitting, and initially people are just sort of in shock, I think, about it. But by the third quarter of 2020, it's getting close to 2% rise per quarter. In the fourth quarter and the first quarter of 2021, it's above 2%. And then in the second quarter of this year, home prices advanced across the board in the United States. This is summarizing, of course, at a rate above 5% in just one quarter. So you layer that on to the previous several quarters in the twos area, and now you're talking about some serious price advances across the country.
Yeah, huge. And as you said, the frenzy around buying a house, because it was so hard to find, people going in and bidding over. Like I have heard clients share with me stories of going 150,000 over. And actually, you had mentioned millennials. I have a millennial client here that was looking to buy, and she was buying while things were at its hottest, really, like the second quarter of this year. And the only way she was able to get in is a friend of hers, neighbor, who'd been in an older home for 30 years and hadn't renovated it, talked to their friend about selling, and they said, "We have a buyer for you."
Oh.
So she was able to get in for that, but she kept getting outbid for months and months on properties.
So that raises a good question, guys. So if I know we're not here to give generalized advice to people, and so there's not, and even if we offer generalized advice, it's not going to be appropriate for any sort of individual circumstance. But as you try to step back and think about, okay, if it's a bubble, what would your decision-making process be? If you're in a bubble, as a seller, you're going to probably try to unload that property if you've been thinking about selling, and not be left holding the bag and watch the price subsequently drop on you. And if you're a buyer, you're going to probably play a waiting game and see if you can't get in at a lower price. But if it is, in fact, not a bubble, and instead this is just for a variety of underlying reasons, strong balance sheets of borrowers who are making it through more stringent borrowing standards and still coming to the table with both a healthy down payment as well as approval on a loan, constrained supply, extremely low interest rates that look like while they might move higher, and who knows, they might move to 4. Who knows? By the end of 2022, who knows how quickly the Federal Reserve will ease up. They've been saying they're going to ease up, and it just seems like it's an endless story of promising to ease up and then not for this or that reason. But under those circumstances, all of these forces that seem to be supporting these prices, what should your strategy be? Should you sit on the sidelines and wait? Should you just or get in there and be part of the frenzy and try to battle it out for that house and find the one that you want in 1 week's time? Or how would you approach this if you were thinking about this as a boom, not a bubble, fellas?
I've had this conversation with multiple people, right, with buyers all the time, and I will normally say you've got to look at your time frame, right? If you're we have a new client we just started working with recently. She wants to move to Florida, and she's not sure if it could be as soon as 2 years from now. So we told her, we think it's a little risky if you can only commit to owning this property for 2 years to go in and buy. So the longer you extend that time frame, and it also goes to a comfort level with the risk, right? She could say, well, I think this area is going to keep going up. Let me buy and go and continue. The other important point on these real estate decisions, why time frame is so important, is you've got the transaction costs, right? You've got to pay the realtors and you've got to pay the transfer tax. So you're looking at over 7% in cost when it comes time for you to sell. So you not only have to be concerned if your time frame is short, you not only have to be concerned with, well, is this a bubble or not, but you've got to say, not only do I need to at least maintain my price ideally and go up, you've got to go up enough to cover those costs to try not to have a loss. And to me, that what answers that is time frame. So I'm not directly answering your question. Maybe it's partly fear of anyone making any move when I don't know their full situation. But my answer to you would be, if I'm a buyer and I'm concerned that it's a bubble, consider my time frame first. If I'm a buyer and I think it's a boom, a shorter time frame may be more comfortable. But I usually say you really want at least 5 years at a minimum if you're going to make this kind of home buying process. Using inflation as a guide, you need over 2 years of inflationary growth just to break even on transaction costs. And that's not considering whether are we in a bubble or a boom, because if it is a bubble and it goes down, you now need greater time for it to recover.
Adrian, any thoughts about it?
Yeah, I really like what Roshan said. Time frame, obviously, liquidity is like a big thing because right now people are like purchasing these homes with like cash bids right now. So that's also another aspect of it. And just monitoring the environment, I think, are all great points.
Erik, how about you? What would your thoughts, or what would you share to someone who's dealing with this right now in real time?
Yeah, I think if you're waiting for the perfect house to show up and stay available for you, you may be perfect price, perfect location, perfect everything. You may be setting your standards a little bit too high. And I'm not saying you want to get into a home that's not the right fit for you or what have you, but it might be that you just have to accept that, hey, you know what? Maybe if we're in a situation where we need a home, we're just going to have to accept that maybe it's not the A+ home that we were looking for at the A+ price we wanted, and we'll get into a home that hits most or checks off most of the boxes. And then, as you said, we'll allow a time frame long enough to make sure that, irrespective of what happens on the pricing side, we're going to come out on the other side of it without too many regrets.
Yeah. Interesting. I didn't know. For our listeners, the way we prepare for this is we said, we want to break down housing. Here's our article to sort of be the starting point, and then go look at it. I didn't know if we'd agree or disagree. So I've heard from listeners, and I myself enjoy when we disagree. But we seem to agree with a lot more than we disagree. Where I think you've got to be careful. In general, this is a huge buying decision, so be careful and think it through. But am I wrong in saying that the three of us, we don't think this is a bubble at the moment? Is that fair to say?
No, that's fair to
Yep.
say.
Excellent, gentlemen. Interesting episode. Great topic this week. For all of our listeners, thank you for joining us again for another episode of the Retirement Lifestyle Show. We'll be back next week with a hopefully as interesting and riveting topic for you. Please like, subscribe, tell your friends and family. Thank you again. This has been the Retirement Lifestyle Show.